Hey YouTubers, today's video is going to be about an introduction to investing. When I thought about investing, the first thing that came to my mind was you need some kind of finance degree, you need to be like a banker, sometimes starting with a W, and they wear suits, they have lots of money, and that's the only way to really get into the whole world of investing. Now, back in the days, that was pretty much true. Like, you needed a lot of time to read about the economy, analyze lots of graphs, learn multiple strategies, find a broker. Then, when you're ready to call the broker and ask them to buy your shares on your behalf or any money that you've made, you then put it into housing, investments, and all sorts of things like that. And basically, it just felt like you couldn't do any investments being someone who works in a 9 to 5 kind of job. But now, things have slightly changed thanks to technology. Now, the whole reading about the economy is still definitely true. You have to stay on top. You need to know exactly what is going on with the world in order to really invest your money properly. At the same time, it's got easier to actually do your research because there's things like YouTube. The internet has become so much more better than like 20 years ago. You obviously still have your newspapers and whatnot, but you can also get all of that information online very easily just through a Google search. There's also a lot of people out there doing their own blogs, like this one, to give you more information of what's out there in the world. Also, now we have stocks and shares ISA accounts, so you can just save money like that and be investing into the stocks and shares market. But then there's also now apps. Now, I personally use an app called Free Trade, and we'll talk about that a little bit later. So, what is investing? Now, in very basic terms, investments is basically something that you buy or put money into in order to make a profit. Now, it seems quite simple. Now, I would say there's 4 main types of investments that people usually do in this day and age. You've got your shares. This is buying a stake in a company. Then there's cash savings. This is where you just put your savings into a bank account. Then you've got property investment. That's buying a physical building. Then we have fixed interest securities. These are basically bonds. And it's essentially a way of loaning money to a company or the government and getting a rate of interest back. Now, there are many other ways of investing as well, such as foreign currency, collectibles like art and antiques, commodities like oil, coffee, corn, rubber, gold, contracts of difference. Now that's where you're betting on shares, whether they're going to gain or lose value. But the rule of thumb, essentially, is to invest in multiple different areas. Now, the whole idea of this is to have a diverse portfolio because different things will work in different ways. You could invest in stocks and shares and your money could go up, but at the same time your money could go down. So it's always good to have some money invested in shares, some money in property. Again, property values can go up or it can go down. Have some cash savings. Again, the interest rates can change, and according to the rate of inflation will depend on what that value of your money saved in cash is going to be worth at a later date. Now, obviously, there's always collectibles. You can always buy some art or some antiques and then just see the value of that increase. Also, when you buy commodities, again, as you can see in the last week, oil just plummeted down and therefore there's risk there as well. So it's quite easy to see why having a diverse portfolio can really help in managing your risk, because when one thing can go down, another thing can go up. So having that diverse portfolio will keep you on a bit more of a balanced level ground. But with all of these investing types, one key thing is to have knowledge on that area. There's no point throwing your money at something just from watching a video like this without doing your own due diligence. You have to know exactly what you are actually putting your money into, because there's so many different things that can go wrong, but also there's so many things that can go right. If you know enough information about what you are investing in, it can reap great benefits. But without knowing enough information, you can lose a lot of money as well. Whenever you think about investing, you should always think about your returns. Now, what is your returns? Essentially, your returns is your profit. It's what you earn from your investments. Now, these can come in forms of dividends. So this is money that is paid out from a company, usually on a quarterly basis. So say you buy some shares in a company, and then they would pay dividends out of their own profits to their shareholders. And this can be on a quarterly, monthly, depending on the actual company. Essentially, it's the same as investing in a property and then renting it out. You then get rental money as a profit from your properties. And similarly, this comes in the same place with cash and bonds, where you have interest. You invest your money into a cash ISA or bonds, and then you make a profit through interest. You can also get capital gains and losses from when you buy something at one price and sell it at another price. Now, the difference between the two is either your capital gains if it's a profit, or a capital loss if you lose money. Now, when you outsource this investing to other people, managing investments takes a lot of time and money. So there's usually a cost involved in this. So you should always check what that managing cost is before making an investment, because it could really make a difference to what your returns could be. Now, the next thing to think about after investing and returns is your risk. No matter what anyone says online, there's no such thing as risk-free investment. Now, if you want to make a lot of money really quickly, it's possible, but there's a very, very high risk. Now, that is a very high risk in winning, which means, yeah, you could make a hell of a lot of money, but at the same time, there's a very, very high risk of also losing, therefore losing all your money as well. Now, out of all of the investing types that I mentioned, one of the biggest risks is probably contracts on differences, because essentially you're just betting. At the same time, you also have stocks and shares. It's very similar, however, there's a lot more information and details about a stock and share that can educate you to whether you buy it or not, and also you also get the extra bonus of dividends. Now, also cash in savings is also risky, because you can risk losing the value of the money that you have invested. Because, for instance, let's take your interest rate does not correlate to the inflation in the market. However, you can also put your cash into index-linked investments, and that follows the rate of inflation, but not the market interest. So if the inflation goes down, you end up with less than you expected. Now, the history of the stock market basically shows that you could probably beat the inflation and interest rates. That's why it's recommended as a very good way of investing your money. And it's also why the rich invest so heavily into the stock market. And it's also probably why the rich get richer. But obviously there's also a lot of risk involved, because the share price could be lower at the time that you want to sell. This is the main reason why diversification is key. So the big question here is, when should you invest? A lot of investors and a lot of books, etc., do all mention that the best time to start investing is once you've saved about 6 months of salary. Now, yes, I agree, but I also find that that's a little bit hard in this day and age. So the way that I like to invest is by taking your pay, minusing your living cost, and then splitting the excess into 3 areas: savings, investing, and then enjoyment. So savings is easy. You can put money into a bank. You can then put it into a cash ISA, and then you get some tax-free benefits there. However, there's also a risk in cash ISAs as well, because currently the interest rate on probably one of the best cash ISAs out there is about 1.19%. This is reduced from 1.35% from the beginning of the year. Now, inflation is at 1.5%. This then means that your purchasing power of the money that you're saving inside your cash ISA is going down in value. The reason for this is because your interest rate is only 1.19% and the inflation rate is 1.5%. Therefore, you're losing a purchasing power of 0.31%. However, this is only on your purchasing power. Your actual cash amount is still going to stay the same. Now, if you are a little bit riskier, you can put your money into a stocks and shares ISA. However, stocks and shares ISA usually has a fee involved with them. Now, this fee comes in 2 forms. There's a platform fee. Now this can be anything up to about £10 a month. Then there's a shares dealing charge, and this is the amount that they charge for every share that is actually dealt. Now this can be anything up to about £20 per deal. The top rated stocks and shares ISAs out there are probably a company called Interactive Investor, Hargreaves Lansdown, then you've got Vanguard and Fidelity, and then you also have your banks and building societies like Halifax and Nationwide. However, personally, I've started using an app called Freetrade. Freetrade has two types of accounts, a basic account and an ISA account. The basic account is completely free. I mean, there's a cost involved in buying a share. However, there's no other costs involved in having a basic account with them. And I'm starting off with the basic account because I'm just starting in my investment journey, and anything below £12,000 in capital gains is tax-free. The same applies for dividends. Anything below £2,000 is tax-free. Once you hit those thresholds, that's when you have to start paying tax. Therefore, it makes sense to switch to an ISA account at that point because you can invest up to £20,000 a year tax-free. This is when I'll probably switch to a Freetrade ISA account because they only charge £3 a month. I'm probably also going to open up a stocks and shares ISA account, and I'm going to just save a certain amount of money and put it on some index funds. On a later video, we'll talk more about index funds, and I'll also do another video on the Freetrade app and how you can actually use it as well. But for now, I think I'll keep it at that. I hope you've learned something about the basics of investing, and hope this has been kind of like an introduction to how you can start getting your knowledge about investing. Obviously, I'm going to be making more videos, hopefully twice a week. And if you're interested and you like what you're hearing, and if you like the videos, don't forget to subscribe and hit the bell button so you know when the next video is up. And don't forget to like, share, and comment. Till the next video,